At exactly 3:17 a.m. Eastern Time this morning, something inside the North American financial system suddenly stopped working. Without warning, more than $640 billion in cross-border assets were frozen almost instantly, sending quiet shockwaves through trading desks, energy markets, and government monitoring centers across the continent. No announcement came first. No emergency briefing followed, just a silent financial disruption that analysts say may be tied to an escalating conflict surrounding a $912 billion strategic energy corridor connecting two of the region's largest economic blocs. Within the next 11 hours and 26 minutes, the situation escalated rapidly. Energy markets erased nearly $387 billion in value, while policy insiders began warning that a 42-hour ultimatum may already be ticking behind closed doors. So before we go any further, subscribe to this channel right now, because by the time mainstream networks catch up to what may have started overnight, you could already be a full day behind the real story. In the next 12 minutes, I'm going to break down exactly what triggered this sudden financial freeze, why a $912 billion energy corridor has quietly become the center of a continental power struggle, and how a 42-hour deadline could force one side into a decision that reshapes the economic balance of North America. We'll walk through four key pieces of evidence: the hidden economic pressure building behind the scenes, and finally, the three scenarios analysts fear most if the countdown actually reaches zero. Stay with me, because the final scenario may explain why markets reacted so violently overnight. To understand why $640 billion in assets could freeze almost instantly, we need to look beyond the surface explanation, because events like this do not happen randomly. Financial systems this large only react that violently when multiple pressure points collide at the same time. And according to analysts tracking the situation, there are four critical pieces of evidence that explain why markets reacted so aggressively overnight. Evidence 1. The energy corridor trigger. The first signal came from the $912 billion strategic energy corridor connecting two of North America's largest economic regions. For years, this corridor has functioned as a critical artery for oil, liquefied natural gas, and electricity flowing across the continent. But over the past 72 hours, several policy insiders reported unusual regulatory movements tied to that corridor. Licensing approvals slowed down. Customs clearances began taking hours longer than normal. Energy trading desks started noticing sudden contract verification delays. Those might sound like small bureaucratic changes, but inside energy markets, even a few hours of disruption can trigger enormous financial consequences. When traders realized that shipments tied to this corridor might face sudden restrictions, automated risk systems reacted immediately. And once those systems began recalculating exposure, the result was a rapid chain reaction across commodity markets. Within minutes, liquidity safeguards kicked in, and that is when the $640 billion asset freeze began spreading across cross-border financial channels. This was not a political announcement. It was the financial system protecting itself from risk. Evidence 2. The financial defense mechanism. Large international markets operate on something called systemic risk containment protocols. These protocols are rarely discussed publicly, but they are designed for exactly this type of scenario. When algorithmic monitoring systems detect instability tied to critical infrastructure, like a continental energy corridor, financial institutions can trigger temporary safeguards designed to prevent cascading losses. According to several market observers, the sudden freeze of cross-border assets suggests that multiple institutions activated those safeguards simultaneously. That is extremely rare. To put this into perspective, during the first hours of the 2008 financial crisis, risk protocols activated within individual banks. But analysts say what we saw overnight appears to be a coordinated defensive reaction across multiple financial networks. That is why the number involved, $640 billion, escalated so quickly. Not because governments ordered it, but because the system itself moved to contain potential exposure. Evidence 3, the market panic signal. The third piece of evidence comes directly from the markets themselves. Within 11 hours and 26 minutes, energy markets erased nearly $387 billion in market value. That type of rapid decline almost never happens unless traders believe a major structural disruption is imminent. Energy futures began showing abnormal volatility. Insurance contracts covering infrastructure routes suddenly spiked. Several large commodity funds reportedly began shifting capital into defensive positions. One market strategist described the reaction in simple terms. When traders believe a strategic supply corridor might become unstable, they price in the worst possible outcome immediately. And that appears to be exactly what happened. The moment the risk calculations changed, automated trading systems began pulling exposure from energy-dependent sectors, which explains why the sell-off spread so quickly across the market. Now here's the moment where many viewers begin to realize just how serious this could become. If you're starting to see the scale of what might be happening behind the scenes, go ahead and hit the like button, because the next piece of evidence explains why analysts believe a political deadline may already be ticking. Evidence 4, the 42-hour deadline. Behind the financial shock and the market panic lies the most important factor of all, time pressure. Policy insiders have been quietly discussing what they describe as a 42-hour negotiation window tied to the dispute surrounding the energy corridor. While details remain limited, several analysts believe one side issued a strict ultimatum related to transit conditions, regulatory control, and infrastructure oversight. In other words, the dispute is no longer purely economic. It has become strategic leverage. If that deadline is real, it means negotiations are now happening under intense pressure behind closed doors. And the markets, which constantly monitor political risk signals, may have already detected that the situation could escalate. That would explain the speed of the reaction. Markets hate uncertainty, but they fear countdowns even more. Why analysts are watching this so closely? One of the most striking reactions came from billionaire investor Warren Buffett, who has repeatedly warned about how quickly infrastructure disputes can ripple through the global economy. In past interviews, Buffett explained that when strategic supply routes become unstable, the consequences can move far beyond the immediate region involved. Energy markets affect transportation. Transportation affects manufacturing. Manufacturing affects global trade. In other words, a disruption in one critical corridor can trigger economic shockwaves across entire continents. And that is exactly why analysts are paying such close attention to the 42-hour timeline now being discussed. Because if negotiations fail before that clock expires, the financial safeguards we already saw may only be the first stage of a much larger economic reaction. The quiet question markets are asking right now. Markets are trying to answer one simple question. Is this situation going to stabilize, or are we watching the early signals of a much larger economic confrontation? The $640 billion freeze suggests institutions are already preparing for risk. The $387 billion market drop shows traders are adjusting expectations. And the rumored 42-hour ultimatum suggests that whatever negotiations are happening behind the scenes may already be approaching a decisive moment. That is why analysts across financial and policy circles are watching the situation so closely. Because if that deadline passes without a breakthrough, the next phase may not involve quiet financial safeguards. It could involve structural economic retaliation. And that possibility leads directly to the question everyone is now asking: what happens when the countdown ends? Now, the question everyone is asking is simple. What happens when the 42-hour clock reaches zero? Policy analysts say the outcome could move in three very different directions, each carrying dramatically different consequences for markets, governments, and the balance of economic power across North America. Scenario 1, full de-escalation. The first scenario is the most stable, but also the least likely according to several observers. In this outcome, negotiators reach a rapid compromise before the deadline expires. Regulatory conditions around the $912 billion energy corridor would be adjusted, transit guarantees would be reaffirmed, and financial safeguards would gradually be lifted. If that happens, markets could rebound quickly. The $387 billion in erased value might begin recovering within days as traders regain confidence that the supply corridor remains secure. But even in the best-case scenario, the shock we just witnessed would leave a lasting mark. Investors would remember how quickly $640 billion in assets could be frozen when strategic infrastructure becomes politically unstable. In other words, the system might calm down, but the trust inside the system would already be weaker. Scenario 2, partial compliance. The second scenario is far more complicated. Here, one side accepts some of the demands tied to the corridor dispute, but refuses to fully concede control or regulatory authority. That creates a fragile middle ground. Transit might continue, but under stricter oversight. Financial safeguards might remain partially active. Insurance premiums for energy shipments could rise sharply. Markets hate uncertainty, and partial compliance creates exactly that. Under this scenario, analysts believe we could see extended volatility in energy markets, with periodic capital withdrawals from sectors tied to infrastructure, logistics, and industrial supply chains. The result would not be an immediate collapse. Instead, it would be something more subtle, a slow erosion of confidence that spreads across investment decisions over months rather than hours. That type of instability can quietly reshape economic alliances over time. Scenario 3, full economic confrontation. The third scenario is the one analysts fear the most. If negotiations collapse entirely before the 42-hour window closes, both sides could escalate rapidly. Financial safeguards would likely expand beyond the initial $640 billion freeze. Additional asset restrictions could appear across banking channels, trade financing, and energy settlements. Energy flows through the corridor could face direct limitations. And once supply routes become politicized, retaliation tends to follow quickly. One side could impose new regulatory barriers. The other could respond with countermeasures targeting financial exposure or infrastructure access. That is how economic disputes transform into full-scale economic confrontations. The immediate result would likely be deeper market shocks, far larger than the $387 billion drop we already saw. But the long-term consequence would be even more serious: a restructuring of economic relationships across the continent. And once systems begin reorganizing around new alliances and new supply routes, those changes can last for years, sometimes decades. Right now, the markets appear to believe we are somewhere between Scenario 2 and Scenario 3, which means the most important variable is no longer the financial shock we already saw. It is the time remaining on that 42-hour clock. Because once the countdown reaches 0, the next move will determine whether this crisis fades quietly or becomes the opening chapter of a much larger economic conflict. Right now, the most important thing to understand is this: the clock is still ticking. A sudden $640 billion asset freeze, nearly $387 billion erased from energy markets, and a 42-hour deadline tied to a $912 billion strategic corridor have already shaken confidence across one of the most important economic regions on Earth. Whether this crisis stabilizes or escalates will depend entirely on what happens behind closed doors before that countdown reaches 0. Because once strategic infrastructure becomes leverage, the balance of economic power can shift very quickly. So the real question now is this: did one side push the pressure too far, or did the other side underestimate the consequences? Let me know what you think in the comments. I read every perspective. And if you want to stay ahead of the next development, subscribe and turn on notifications, because this story may only be getting started.